welcome Hardika on the board. These digital times, we have been stick to the screens is something which personally I don't like. Have been a stage where we would have welcomed you, would have been great. But the time will come. Very soon the time will come.
I'll hold you to it.
Absolutely. Let me take this opportunity to first introduce Hardika. I think, founder and CEO of Kinara Capital. Hardika Shah is the founder of the fintech. I think one of the very unique fintech, I would call it. And she would, while our discussion will happen, she would talk about that. But that is powering the financial inclusion of small businesses entrepreneurs in India. While, she's from Columbia Business School, was highly motivated to address the missing middle credit gap for MSME. And I think one of the topics which I am personally bound is about MSMEs deadlock. And we will discuss about that, while we have our discussion, Hardika. But I think she has been working very closely with MSME and stifles entrepreneurship in India, the land of Jugaad. I think that's where people have been famously recognizing us. The success of the business school pilot became the genesis of her journey into a social entrepreneurship. And she wrapped up her life in Silicon Valley and headed to Bangalore to build Kinara Capital. I think previously she has worked in many organizations, including, I would call it Accenture Consulting, Accenture Development Partnership, Acumen Fund, Stanford University. There is probably 2 pages of introduction where I would go on and on, Hardika. So it's kind of honor and a pleasure to introduce you, Hardika. Thank you very much for joining. And let's make the last session the most interesting session as such. Now, as the topic says, right, we are talking about 30% of the GDP movement happens through MSMEs today, right? Personally speaking, these 30% of the MSMEs also feeding the 70% of the GDP as well, in some shape and form, right? They're kind of their supply chain in a way to look at it. So I would probably say that if 30% is not moving, then the rest of the 70% still needs to hinge on these 30% as well. So there's a lot of deadlock which happens there. Second, I think India is the country which has seen India and Bharat. And this has been debated like left, right, center across the board. That how this India has developed and how is Bharat being developed, how Bharat and India can come together actually. So that's my first question to address to you. I think, MSME after the pandemic, there are a lot of issues. Migration, labor have gone back. They were stuck. They are back to their own startup zone, I would call it. They are family-owned businesses. Their books are not as not clean, I would call it, or not as exposed as we would have liked to. The inclusion in the economy has to be brought in. Though there has been a lot of improvement, but yet to see that kind of a penetration. And I haven't seen credit being used by them as structurally as outside India, actually. I think you have seen both the worlds outside India and India and now operating a successful fintech. So, let's talk about this. How do we build and create one India rather than India and Bharat working together separately?
Well, I think to start with, then we need to understand the MSME is not one blob, right? We talk about 60 million of small businesses in India, but more than 90% of them are less than 5 crores in annual turnover, which means that by definition, they're less formal in their structure, they're less formal in terms of where they land. I mean, they can't get a rating if you wanted to sort of think of it from a formality of how they would get access to capital. And that's why only 5% of them have access to capital. And so it becomes a little bit of it's a hard nut to crack, because on one side, the way to get access to capital is if you have transparency, information, verification. And on the other side, when that is not available to the very engine, and like you said, this is the engine of the nation. It employs 120 million people, although I know that a big portion of 25% of that have lost, those livelihoods right now. But we do believe that they will come back, right? That there is hope, and that this is a blip in our lifetime for all of us, but that MSMEs as well will come back, and these jobs will come back. Maybe it'll take a little longer than we would like, but it will happen. So then how do we bridge this gap? Because on the one side, if the bank credit And let's look at just, latest information that is from RBI. Only 17% of the bank credit that was disbursed in July went to MSMEs, which, like you said, make up 70% of the output of the nation. So we have a mismatch, and that is then further amplified by COVID, by the lockdown, and also by the simple fact that a lot of them don't have land or property collateral. We are seeing a lot more LAP, loan against property loans, happening off lately than they did before. But if you don't have land or property collateral and you are in the unsecured side of the lending need, then you're further pushed down in terms of this access to capital. So we need to solve for this. And this to me is the Bharat problem. We heard this morning from several of the panels that, we had one organization that was specifically and clearly saying, I'm going after the India problem, right? This is the tax layer. This is where I have information. This is the savvier customer. We need to get Bharat to be the savvier customer, and for us to get savvy on how we service them differently than perhaps we have done in the past.
No, I think you raised a very good point, and it's a leading question which I'm coming to, right? So India largely has been an asset-based, access to credit, right? Mm-hmm. And as you said, 17% banking community provided MSME loans, whereas we are moving 70% of the engine on to move that, right? So this mismatch is a huge mismatch. A lot of these organizations don't have the assets to go back to the banking community and say, okay, fine, guys, I need access to the credit. Until they have access to the credit, they are either stuck in the ceiling, they can't progress, they can't grow, their reach gets stagnant at some point of time, or they would probably go by other means. Somewhere Hardika, you found this gap as a major gap in the country. And I dare not say, I think now we have heard fintechs talking in the previous panel and the other people that the needle has started moving, and you were the first one to actually move that needle, right? When I'm saying, can we assess the cash flow, future cash flows, and try to close that gap? Largely, how do we move the needle towards the unsecured loan, and how are you now operating in that environment?
Yeah, I mean, so just to perhaps a little bit of background, right? We call ourselves the socially conscious and then now systemically important NBFC that is driving this financial inclusion by providing unsecured loans, business loans for micro enterprises in the average 3 to 5 lakh range. And we are solving this large missing middle credit gap, right, by doing this across manufacturing, trading, and also some services. What we have discovered, and I was really happy to be listening into the panels this morning, because I literally sat there and I said, yep, I agree with everything, TT and Manish and everyone is saying, right? Yeah, there is they have history, they have experience, they've been doing this for years. And then I'm listening to Shashank and Ashneer, and I'm like, yep, that's the future as well, and that's here. The future is now. And what we are doing is essentially a blended model of both these things. We are traditional NBFC in that sense, and we are technology driven on this side, and that has allowed us to both be confident in serving a unsecured business lending market by doing the last mile field based data collection, data digitization, and data understanding, but then doing all the credit underwriting through level of technology, data science, and algorithms. And then by blending these two, we have been able to do 50,000 plus loans over the course of the last 7-8 years and been profitable for 5. So the fear that unsecured business lending in this country is a negative proposition is now at least to an extent, and we are still a small or at least a medium-sized NBFC. So just one data point, statistically, hopefully significant still, that we are essentially able to demonstrate that there is a scalable, profitable model to be built in the unsecured business lending market, and that perhaps that what we have to overcome, and COVID may be a great opportunity if we want to consider it, that is we have to overcome our own fears going into this space. I think TT said it in a couple of sessions back that it's not fair to say that we have, we had loose credit before, right? We had a credit model before and we all believed in it. We have to transform that model now. And while we are thinking of transforming that model, can we expand? Can we be more inclusive? Can we think of unsecured as, again, just a risk reward mechanism, right? There's a different level of risk associated. And we can, we charge a higher interest rate for it because that risk is a risk-based, premium that is built in. And that's what is important, that we need to move towards expanding our own view on unsecured lending as an ecosystem, and especially those who are sitting on tons of capital and are highly capitalized. This is a perfect opportunity to experiment in the unsecured lending by taking a little bit of what you would consider the cream of that and get comfortable around it, and then essentially, be able to expand the flow of credit to into the back into the community.
So great point, actually, Hardika. I think, when we look at local, regional aspect, there are two things which will emerge. One, India is a country of many countries, actually, right? And, there has been, graphical output where it says that, Uttar Pradesh is equivalent to a full Europe, let me say this way, right? But let's see this way. Now, vernacular, language, cultures will be different, right? So the demand and the people have today, the access to the credit is also linked socially as well. It's not linked just economically. Second part of it is, as a question I'm going to ask you is, how do you deal with this complexity? And the second part is, we have seen statistically that the larger enterprises and the larger access to credit are the bigger defaulters. They are contributing to higher amount of, of non-performing assets today, right? Whereas in your case, we have seen that MSME actually pay back a lot. So recoveries are much higher than actually, a country average is around 25-30%, which has increased over the period of time. But if you say global averages, we are just started. That's it. Nothing near to that. So this creates two problems at your end. One, unsecured gives higher risk. How do you deal with the higher risk? And what's your statistics at your end? Secondly, how are you dealing with this local or country of many countries actually?
Yeah, and so the higher risk, look, everything we do, it has an element of risk, so higher risk is only in relation to the return profile of any business. And if the return profile of a business stands at the same level as any other business that quote unquote is perceived as lower risk, then ultimately, both from your lender community or from your investor community, you're delivering shareholder value. And that's equal to, at par, if not better than anything else. So to me, higher, lower risk is a mental model. Rather than a finite sort of model, if you will. The localization piece, and this is where the India versus Bharat comes together. I think that we heard this through today that how regulation has played a big role, and how the RBI is actually quite forward in the regulations, and has really, in this year, even the finance ministry has come together to push the agenda around MSMEs. And a lot has been done, and a lot more does need to be done as well. Yep. But what we often, and maybe what we ought to also talk about is the enabler. So Aadhaar has been a tremendous enabler. We talked about that. The digital components and digitization, the KYC and e-signing has been a tremendous enabler for us as a nation to do stuff. At the same time, the unexpected tremendous enabler has been practically free data and the proliferation of Android phones. And so even when I look at our own customer base is typically first generation entrepreneurs. And probably about 8, 9, 10 years ago, when we would do our customer meets, right, they would be walking around with the old Nokia H270s. But now everyone has an Android phone. And what we are seeing in this move that is happening, that with digitization, with access to information, more and more Indians are actually coming into the fold. Information dissemination is no longer the problem, right? And I think Google stats, there was some Google stats that I saw that there's been a 10x growth in local language queries in the last 10, 12 months. I mean, this is tremendous, right? That means people are online. People are, there's like 200, 300 million users on YouTube every day, and 85% of that is all coming through the mobile. So we see that push is happening. Vernacular, voice, video, that's the shift that's happening. And if we can capture that shift, let me then sort of circle back to what you asked, how do you handle this? We have to be vernacular in how we approach our customer base. We cannot apply India rules to Bharat. We have to bring a blended approach to that. And we are still using the same tech. We're still using the same process, but we are making it vernacular, making it more visual. We're making it more easy to interact with. And blending it back to the field force, to our last mile distribution network, because that is still an important element. It's kind of like what we're doing now, work from home. And while we're all coping with work from home, it is nice to come to the office, and there is a little bit of looking forward to that. The same is true. I think that while digital payments have increased over the last 6 months, that digitization has got this thrust that has happened because of COVID. We need to come back at some point and come back to that blended model, because we do want to go and meet somebody, whether it's for a loan or whether it's for something else. And frankly, as a lender, we also want to be able to meet the micro enterprise and validate some elements of that. So we kind of have to figure out how to blend this and blend it so it's still fast, flexible, and still quick, still gets money out the door to them in a meaningful time frame. But let them also generate and work through the process a lot more on their own in vernacular through tech, right? That's how I see this blending happening.
No, I think I completely agree with you. And there's an element of trust which gets built up if we are vernacular, if we have local people managing and interacting with us. And finance is all about trust. If we don't have a trust in the banking community, I will never put my money in the bank, right? And that used to happen earlier as well. Now, building from a trust perspective, what had happened also is, as you see, 80-90% of the people now using smartphones. So some way or the other, they have internet access. We have seen 40x growth in e-commerce transactions in the last 5 months. I mean, 3 years of journey being done in 3 months, let's say this, everybody is saying. A lot of transactions have come up. Alibaba model of, using those future cash flows have generated social impact and access to credit so much that I can't believe it, right? Whereas recovery rates are much higher, right? I always say that if I take $100 million loan from a bank, $100 million loan, then it's a bank's problem. It's not my problem, right? Okay, but in your case, it's very different, right? So one side is obviously you are digitizing the records, you're bringing them on the platform, you're using technology to decide how much of the credit access you want to give it. On the second side, the collections have to happen. And how are you, that is another mechanism where I've seen not a lot of fintechs have done a great job actually. Still struggling to figure out how to crack that nut. And I see as Kinara Capital, you have been doing it successfully. So why don't you share some aspect of how is the collection happening actually?
Yes, and as you can tell in the conversations earlier today, a lot of the focus in the last 6 months have moved towards collections. We heard about other NBFCs and the collection stats. So for us, collections is an integral part, right? And so our model being blended, we have last mile distribution. We have collections officers who are all on our payroll, who work in our branches. We have 110 branches in 6 states. So we have that distribution. And there's a process, right? So the tech helps in the first part of the process. We have, we are on 400 different apps. So if anybody has money in the bank for whatever reason, technical reason or otherwise, was their ACH bounced, then they could automatically pay us through one of these 400 apps. And some of them are payment apps as well. And if they have cash in hand, as some traders do, there's a little bit more cash in the economy. Even though we are moving towards digital payments as a nation, it's still a heavy cash economy. They could just walk down to a Airtel payment bank and make that cash payment to a local retailer. And by enabling that environment to essentially make it easy for the customer to engage and for our field teams to go out, both in terms of engagement, reminders, as well as the ease of use that we talk about, making it easy for the customer to close the loop, has helped us, with managing a book as big as this, and helped us manage our collections even through this lockdown period. The other thing that we talk a lot about in lending, about underwriting and risk and underwriting, and how do you use data science and machine learning and algorithms and all the rest of it. We started our own journey first solving for the collections piece and saying, how do we do this on the collection side? And then kind of coming back to the underwriting side, because cash flow based underwriting, as you brought up before, it's a fairly easy box to pencil around, but collections is the more complex piece. And so we started there with our data science work and have built quite a lot of, in-house tech and knowledge and algorithms that allows us to be efficient around the collections piece as well. And I think, I want to come back to the point you were making about how, and the stats, don't quote me on this because I don't know where the origin of the stat is, but it is fairly telling, right? That 55% of PSU lending, this was a few years back, so I don't have the latest information, went to 300 corporates. 300 corporates, that's it. So you said it, right? The money is, if you don't need money, you're going to get it. And it's the small micro enterprises who just need a little bit of capital who are struggling to get it. So when they do get it in a formal, efficient, and real way, the propensity to want to pay that back is far higher, and it's far more personal to them to do this rather than yet another machinery that has to pay another machinery, if you will.
No, so I think
that's the other cultural element of our, that we need to also rely on.
No, you're right, actually. So I may say this way that, let's say fintech or NBFCs versus banks. So public sector banks specifically, they have the muscle, they have deep pockets, they have access, but they haven't leveraged that so far. And the reason they haven't leveraged so far, because I call it lazy lending. It's a word which is prevalent in the industry today, right? If I can get away with 300 organizations, why should I be bothering about 3 lakh organizations in the country today, right? The whole architecture, the whole field force required, the hybrid technology and physical integration required. It's a lot of work to be done there. People don't have the right skills, right architecture to play there. And they are not nimble enough. They are not nimble enough, flexible enough to do it. Whereas the fintechs such as yourself, I have seen, and they are, even in the pandemic, we heard in the last panel, right? There is no fear they have. No survival issues are there, right? They have cash in their banks, capital raise, where they can't burn it enough. I was almost about to, switch on my screen and say to this gentleman, I have my resume, guy, I will send it across to you, right? Burn some cash, right? Okay. But, and that's a big difference we bring in. So from that business side, I think we have discussed a lot, but I think there is one angle, which is regulation, which plays a very important role, right? There are a lot of barriers, and we are hearing about this shadow banking happening a lot now kind of happening. Now, NBFCs have to be brought in at par of the banking community. Still, it's miles away. Haven't we thought about, right? What some views, where we should strike harder, what should policy framework should look like, and how we should progress further would be helpful.
Yeah, we should start by stop calling it shadow banking. We are really part of the ecosystem, and we are playing an important part of the ecosystem. We are playing the last mile distribution part. We are playing the customer experience part. And so we need to reframe our language first to be able to then do something further with it. But more beyond that, I see that in the last 6 months, both the regulator and the finance ministry has made several attempts to bring small medium NBFCs into the fold of getting access to capital, right? So this is a multi-part, it's a domino effect. For us to do the work we need to leverage our own capital. For us to leverage capital, we need to convince bankers to give us the capital to be able to disperse it out. And you can try to push that from the regulatory side, which was attempted with TLTRO 1.0, 2.0, and so on, and even ECGLS. We heard this morning that, look, so much of ECGLS is still not made available So how do you get that? How do you get that to the micro enterprise? How do you get that to the small business that could really use a small working capital loan right this minute to really just get over the hump? And we are doing a large disservice to this community of first generation entrepreneurs, or just any kind of entrepreneur, small business entrepreneur, that by not making that capital access happen. I really liked the idea on one of the panel this morning that talked about a special funding mechanism that could be governed by someone, but that needs to be a permanent mechanism for really shoring up and support of the small and medium NBFCs, because we were minute at one point. We have become systemically important today, and we hope to grow 4 times, 5 times this, over the next 3-4 years. And so it would have been great to have that. I hope that we think of avenues like this that creates a special vehicle to fund the small and medium NBFCs to then be able to move the bar. The debt requirement in this country is humongous, and all of us put together needs to do more than, right, instead of sort of figuring out where the gaps are. We need to really start thinking of how can we complement the different parts of the ecosystem to move the bar, to reach that customer that really in the end is going to shift the economic output for our country. Right. So that's where I feel that needs to be a real special play here for small and medium NBFCs on the regulatory side, right? I mean, look at what we have done with NBFC MFI. We have done so much great work by classifying NBFC MFI, but anything else is just one big bucket. Maybe we need different classes of NBFCs also, and different schemes and programs and mechanisms for those smaller NBFCs to also be able to move up. Just like our customers need.
Absolutely. I completely agree with you. So I have two sides of the story to play and go forward, and that would be the last part of our discussion. I think I completely agree, and I will zoom out a little bit. See, I think payment banks have been, created to create a payment ecosystem in the country. And some of the people have probably efficiently, utilized that. So they can have some kind of a cheap credit available to them as current accounts and saving accounts with them, right? And they can be in the field of lending as well, moving forward by partnering with some of the fintechs such as yourself. I think RBI in this sense needs to really come out with MSME banking license or a banking license of different types and on the tap, so that companies such as yourself is able to tap on that licensing and then scale very fast in the country, because you also need access to the credit. But your access to the credit is limited because the banks will somewhere come in and play an important role for you. I think that is very important. Second important is about top-down and bottom-up approach. I think you are doing a great job on a bottom-up approach. You are going to the field, combining the technology as well as field force and doing the business. But top-down approach is still not happening. I mean, we are not looking at independency. So public sector banks are influenced largely by, dependent, umbilical cord of with government associations, right? Somewhere we need to cut this umbilical cord and create an independent structure there where they can actually take some, trustworthy decisions. The governing bodies would be different. Mm-hmm. Second, I think the talent is missing top down, right? Imagine, even they can't map up the salaries of a private sector versus a public sector, right? Let's say this way. So just as basic infrastructure, I'm not bound to bonuses if I am lending poorly or I'm lending strongly, right? So those structures does not exist today. I think that's a top-down approach. And they are not being combined today, I idly say. Somewhere we need to create marketplace which creates benchmarks. I think that's very important discussion for us, right? How to lend, what kind of pricing is existing, right? What is the structure of data which I need to cater to, especially for fintechs, because they are largely dependent on your own data. But your data you're also, Hardika is operating at a cream level, right? Within the MSME, you're always looking at transactions where I can actually go and see it and digitize it. But the larger is still left behind. They still can't be brought in. So somewhere we need to build that marketplace where the benchmarks exist and the reverse engineering can be done so that, we can be much agile and much faster into place. So question is around the benchmark side. Let's address the benchmark. What's your views on that, or a marketplace? And then we go to the last part.
Yeah, look, maybe it's not an either or here, right? I think there's so much to be done. We should attempt many different things. And I was reflecting on what you were saying around the MSME bank. The SFB is if you think of the SFB, that's how it started, right? Microfinance. Nobody really believed in the microfinance model, all of 25 years ago. And now 8-9 of them have become banks, right? This is a pretty big shift in a very short span of time, because we have been able to prove the model. The regulator has come on board. The regulator has created a special vehicle on the NBFC side initially, and then created a potential provision, which, SFPs, I know that not all 8-9 of them were MFIs converted to SFPs, but giving that platform, which is what you're talking about. How do we now do that for the MSME is the next frontier. And to me, then the benchmark piece, the regulation piece, or the special, licensing piece are all possibilities that may probably need to work together or in tandem to figure out what works and how do we define it and how do we classify it and how do we build it. We have moved. We have definitely moved the conversation in this country. And since I started Kinara, there was so much more focused on MSMEs, right? And we have all come to the conclusion that we need to figure something out. So if this is how we can move the conversation forward, we should do it. Absolutely, we should do it.
Sure. And, frankly speaking, the last part which are coming to discussion is we have seen time and again, fintechs and companies come up, they scale fast, they come to some kind of a scale in the country. But after that, they get stuck, right? At some point of time, they have to figure it out. For example, you need to figure it out moving out of 8 states to, let's say, 26 states in the country. And maybe then go global as well, right? Because it doesn't stop. Your model doesn't stop just for one country, right? Now, how do we scale? What are the things we should have it to make sure that the scale happens, whether it's internal factors or external factors? So what are these factors according to you? And, that would be my last question to you.
Yeah. So look, the question of scale is also a question of timing. We can all scale given all the time and resources in the world. And so where are we talking about over what time period and where are the resources to enable that, right? If you look at, so let's talk, since we are in a VC circle conversation, let's talk from the investment side of this. And you probably have far better statistics, so I'm not even going to attempt it. But I'm pretty sure that if I look at the amount of capital flow, investment capital flow into this country, invariably it has gone, the volume of that has gone to, again, much like the PSUs and the 300 corporates, it's gone to probably a very small number of, assets as far as investable assets go. What that does is it stunts the possibility for everyone else, right? Because if there's only a small number of, $500 billion funds, and then they're only investing in 5 companies, then what happens to the other next 50 or the next 500? So we have to figure out the capital flow here to enable the growth as well. And then we have to figure out over that time period, how do we make that happen and not necessarily rush into it, but figure out what is the right scalable, manageable time period, because we are unique. As much as I love the Alibaba story, Alibaba has a lot going in China that is very, very different in terms of dynamic culture, regulation, support, everything for us as a nation, right? So we have to tailor that, and break it into smaller parts to make it work here. And so we need that, extra time element associated with that as well, which if you think of it from an investment point of view, investors have a structure that they follow. They need things to happen within certain timeframes and structures. So we need to break two, three different deadlocks here for that, for that enormous scale to happen over, a reasonable amount of time. And the biggest one of that is the investment capital flow and patient investment capital flow to happen so that we can build the infrastructure that the platform can sit on.
I agree. And I think the most important point you said in the last is called patient investment capital. I think these things doesn't happen in a quarter to quarter movement or 1 year or 2 year. we have seen, just to share some statistics, as you said, we would have better. Yes, we do have it. Right. In 2019, we had almost $9 billion invested by PE, around 125 deals. So far, in 2020 YTD, it's 49 deals and $2.3 billion.
Yeah. So.
Similarly, in acquisition, it was around 78 deals with $7 billion. And in 2020 till now, it's again $7 billion with 41 guys. So volume has definitely gone down. PE investments have gone down. I think because we can actually probably say this year is only a 6 months year, not a 12 months year, right? Because of the pandemic issues and so. Pandemic actually created a lot of opportunities. I think going forward in last quarter as well as the Q1 of the next year, you will see the upstick happening in the investment. The money is lying in the bank, let me tell you. The LPs have given GPs a lot of money. Okay. I think they're still figuring it out. Should I park it now or should I kind of, live with that? So they are cautious about it, but we see acquisitions.
They have to, I'm going to have to tell them the same thing I'm telling the bankers, right? Just open your mind a little. Let's get back to business.
Yeah, but I think most of the country has been kind of, locked down and we don't know what uncertainty is feeling for us. But I am seeing that in the next quarter or so, a lot of patient capital would be deployed for the next 5 to 6 years because the behaviors have changed forever. People are not going to come back from e-commerce transaction back to the roads and so, right? So those are the impacts we will see, and fintech is going to play an important role, right from, machines are going to be deployed as pay per use. So you need to have a sort of a payment mechanism there as well within the machine itself. So the world is going to change forever. But I was pleasantly honored and surprised to see Kinara's success. I think somewhere statistics says you have 1,700 crore deployed, 50,000 loans done. Whatever money you're making is a different part. I think I always call it there is a bigger social impact you're making it. And this is where actually the movement, the engine starts working. And we need more of you to be in the ecosystem, and it's being progressed so far. We should have more of you guys in the ecosystem. But, your insights were very well taken, relevant. I think your feedback to the policymakers and let's say the regulatory should reach in some shape and form. But thank you very much for your time today. It's been an honor and a pleasure to have you on the platform.
It's been my pleasure too. Thank you very much, Shalil. And thanks to VCCircle for putting this great event together. It really was a pleasure.
Thank you.